Hello, everyone. My name is Deepak, and with me is Sanjeev Gupta, CPA. And today we are going to talk about PFIC. I know many of you guys get a little bit scared when we talk about PFIC, that what's going to happen. I'm going to have to pay so much penalties. I have to do so much extra work for my tax return. And some of you guys might not even know about what PFIC is, or why is it required and what happens if you don't file it properly. So we're going to address all of those concerns in today's discussion with Sanjeev ji. But before I begin, let me remind you guys, on February 7th, we have a webinar coming up. So Sanjeev ji will be there, I'll be there, and we'll be available to you to answer any of your questions. So if something doesn't make sense to you about PFIC right now and you want to have your questions answered, then join the webinar. Just go to sanjeevcpa.com and sign up for the webinar there, and then you can ask all of your questions. So Sanjeev ji, first of all, welcome. And second is, let's start with basics. What is PFIC? I mean, sounds like some sci-fi name or some sort of IT name.
Well, the meaning is, we call it, the definition is a passive foreign investment company. Foreign mutual fund companies, which are not closing their books, like India, US mutual fund, all mutual fund companies which are based in US, they close their books annually. And how do we find out? You get a broker statement and a broker statement. On the broker statement, you see capital gain distribution line. That is the distribution done by the mutual fund companies based on their net asset value, based on their performance for the year. Mostly in most foreign countries, some mutual fund companies or most of the mutual fund companies don't close their books. Like in India, we have. So, example of Indian mutual fund is SIP funds, which we know everybody is investing in SIPs. SIPs is a mutual fund, is a passive foreign investment company. Regulations, subject to that regulations. ICSA Prudential. So, whenever you get increase in your income, means you have a possibility of making money linked to insurance or anything connected to insurance, but you're also going to get the money back and also are going to see the growth in your portfolio. That is a PFIC, subject to PFIC rules. It can be ETF, it can be mutual fund, it can be index fund, it can be any fund basically, or any kind of wrapper which has a growth potential and which is going to give a rate of return on your investment. So all the foreign mutual fund companies, all the foreign mutual funds, non-US mutual funds are subject to PFIC, and those corporations mostly make money. 75% of their income come from passive activities, which is interest income, capital gains, or they have 50% of their asset in passive investment. So all those companies who derive income from those passive activities 75% of the time, or invest 50% of their money in passive assets, those are considered as PFIC corporations.
So
So
guys,
that's
so let
that's
me
how
let
it.
me make it simple for you guys. First question you want to ask yourself today is, do you own Indian mutual funds? Do you have Indian ETFs? Or for that matter, I'm using the word Indian because that's the community we're targeting to, but you could be, yeah, I don't know, Canadian mutual fund or Japan
Any
mutual
mutual
fund,
fund,
whatever,
any
it doesn't
mutual
really
fund,
matter,
any
right?
UK mutual fund, you can be Dubai mutual fund, you
Yeah,
can
and
be
I know a lot of
UAE, you
people
can
do
be
that, right?
anything.
Sanjeev ji, people are investing all over the place. Sometimes I see people who have like pooled investments, like they will get a group of people together and they will start doing investments together. I had a couple of clients like that last year. Sometimes people have ULIPs. Sometimes people have other kind of insurance products in different countries. You might have maybe you invested with a hedge fund. Maybe you gave your money to someone that you think is better at managing your money and they are managing it. Sometimes that could be public hedge fund or it could be private as well. It doesn't really matter. Retirement accounts. Sometimes people think retirement accounts are exempt, but usually they are also invested in something passive. Startups is another one. So a lot of time I see, because in Indian community, there's a lot of startups happening right now. So sometimes these startups actually accidentally become PFIC. So I wanted to bring this point to your attention that many of you guys watching this right now might think like, oh, that has nothing to do with me. But there's a high probability that it has something to do with you because you own one of these assets, right? And the definition, like Sanjeev ji said, is very, very simple. If 75% of the income in that fund is coming through passive activity, you're subject to PFIC. Simple as that. And that's a lot of different investment vehicles out there. Now, if you're directly investing in a stock, okay, and they are, a company that is earning something, then you're not subject to PFIC. But everybody else that we listed, you are subject to PFIC. Does that make sense, Sanjeev ji? Did I get it right?
Yes, perfect sense. Any And so in India, what they do is most companies, particularly in India, I've seen not in many other countries, they try to do insurance-backed investment options. So, but the main point is they get the money from you as premium towards life insurance, and they invest that money towards the markets. So in the different uh, industry-wise investments. So and they grow that money. So that's why one has to be very careful. Insurance-linked investment vehicles are subject to PFIC.
Yeah, I think that's a most common one because in India, a lot of products are pitched as an insurance product, but they have an insurance component and then they have investment component. United States is very similar, but I think in India the awareness is not there. Maybe here
Yes.
people are a little bit more aware of
Like I
that.
said, they don't close their, there is no requirement for them to close their books. That's the main problem in India.
So now I think everybody understand why you have to worry about PFIC. Now, first of all, Sanjeev ji, is PFIC a tax or is it a reporting requirement?
It's a very good question. So if you have a PFIC requirement, definitely it's a tax question because you have to report on your tax returns. The income that you earn from that depends on which method you use. It is also subject to FinCEN 114 form if your balance in those mutual funds or in those investment vehicles exceed $10,000 on any day in a year. It is also subject to FATCA requirement 8938 if the balance is more than $100,000 and as on December 31st, married filing joint, or single is $50,000. So it has those requirements, those implications, which has tax as well as compliance requirements.
So let's say if I am invested in a mutual fund, maybe $100,000, right? That might be a good example for a lot of our community. What do they need to do? They obviously need to file PFIC. They need to file
So
FinCEN, and they might have to be required to file the
8938, the FATCA form.
8938 because there's more than 100,000 as well. So you got three of those requirements here. I think most people are probably familiar with FinCEN and 8938 because we've been talking about it for ever now. But you might not be familiar with this PFIC concept. How complicated it is? How long does it take? Talk to us a little bit about that.
Yes, so this form 8621 generally is need to be filed if you get any kind of distribution from the PFIC, from the investment vehicle, any kind of distribution you get, you need to report that distributions. You sell or dispose of these investments in that PFIC environment, or make certain elections on the Form 8621. Now, election on the Form 8621 has three ways. There's a default method and there's two election method. So if you choose the two election method, you have to report on the Form 8621. And of course, the requirements are complex. It takes a lot of time, a lot of efforts because the form itself is so complex. Of course, you have to have one PFIC for one investment brokerage account. If you have multiple brokerage investment in multiple companies, mutual fund companies, you need PFIC 8621 for each of those investment vehicles.
So you can see how
Now,
complicated it can get, especially.
yeah, so if I go into the method of method of that is very complex. Uh, and you need tax planning. So can I go into that methods of this one?
Well, before we go there, Sanjeevji, first of all, I think a lot of people are wondering how is PFIC different than, for example, taxation on anything else? Maybe talk about that because people might be thinking, well,
So
it's just a different form, but it's not.
no, so it's a tax form. Of course, you are subject to any kind of distribution or any kind of gain that you have from that will be subject to a capital gains rate. Any kind of income that is not realized depends on the election you make is subject to ordinary taxes. It's a form, but it's a very complex form. It's not an ordinary form. And the penalty for not doing that form is also very high. And like I said, we also have FinCEN 114 form. So if you declare only the income, but does not declare on the FinCEN 114 form, or it does not also include on the 8938, then the returns are not complete. So you have to be very careful. I've seen people not declaring on the income, declaring on the form FinCEN 114 form or 8938, but not declaring the income, or declaring the income but not reporting on the FinCEN 114 or 8938, or not declaring, just filing the form 8621 as a blank form depending on the method one use, and they just think it will go away. That's not going to happen.
And another one, this you probably have heard this from clients as well, and I hear this every now and then. For some reason, people assume because United States and India has this double taxation agreement, they think that then, since we have the agreement, why can't this be just treated as a mutual fund? Just like they do anything in the United States.
No. People misunderstand the direct tax avoidance treaty. They say, "Oh, well, both the countries have direct tax avoidance treaty. That means if I invest in 100 countries, each other countries, you don't have to report it." No,
Correct.
that's not the criteria of direct tax avoidance treaty. The criteria for direct tax avoidance treaty is to give credit for the taxes you pay in the country in which the income belong to, or in which the country in which you are located in. Depends on the nature of the income and where you are located in. So it's a kind of a credit for avoiding paying double tax on the same income that you're subject to. So it's nothing else. Nothing is says nothing else. That's it. That's the point blank on direct tax avoidance treaty. So don't misuse. Don't try to misread into direct tax avoidance treaty and just think, hey, I got the money from, let's say, salaries or business income, and I put money in India in a PFIC environment, and the money that grows inside the PFIC, I don't have to report it because it's after tax money and direct tax avoidance treaty is there. No, in spite of that, you still have to report it. Like I said, in all the three ways, or one way, whether it's 18938 or 114 or on a tax return, all three of them.
So let's go through an example, Sanjeev. So go back to the original example I gave you. I have $100,000. I did very well last year. I invested in some some sort of passive fund in India, which is earning me great returns. So now I have to first of all file the Indian tax return, wouldn't I? Because I sold something, right? I earned some income.
Yes. So first of all, one has to really see if you have income from other sources other than PFIC environment. Let's say interest income or capital gains or rental income or salaries or pension income. If you don't have those scenarios and you just invested the money in a mutual fund, then there's no need to wait for the tax returns because in India, like I said, the mutual fund companies don't close their books. So the taxability only comes when you sell or when you dispose of those investments. Capital gains is there. If you don't sell or dispose of, or you kind of get a kind of a dividend from them in case they give you the dividend, then reporting becomes there. Otherwise, the reporting does not become there. So you don't have to wait for the tax returns in India in case of only investment. If you have other things, yes, you have to wait. But if you just have investment in that area, you don't have to wait for the tax return because, like I said, PFIC rules are meant only for US residents, citizens, green card holders. It's very unique for US in the US for reporting those foreign mutual funds. In other countries, they don't have those kind of PFIC environment. So you don't have to wait for India return. But if you have other things, wait for the first file the extension for the US tax returns because April 15 is a deadline. In case of India, it's a fiscal year. The filing date is July 31st of the following year. Is April 15th of the following year is US. July 31st of the following year is India. And you file extension for US. Then you file the India return. Then you file the US return after looking at the US returns.
So
After looking at the India return.
So take a
If
look.
you don't have the
So I had $100,000. I made good amount of income. I have nothing else going on in India, just that investment. So I don't need to file the tax return in India. But what happens in US now? I haven't sold anything. So what happens? Do I still need to report it?
Yes, so we are going into the methods of PFIC environment, Form 8621. So the default method is excessive distribution method. Any distribution that comes out from the mutual fund, from the PFIC companies, corporations, is a worst method because it's excess distribution. It's any gain on sale from that investment is treated as not capital gains, it's treated as ordinary income. And there's some interest expense and other things you can show. It's the worst scenario that one can see. And we have seen that other CPAs and tax professionals particularly use this method because they just think this is the best method, but they don't understand this is the worst method because the taxpayer is with you for maybe 1 year, 2 year, maybe it's coming from TurboTax, maybe online or other softwares, and might transition to some other CPA or might transition to other state or might go back to India. So the reporting is not there. So reporting is not complete. The excess distribution method is the worst method, which is default method. If you don't choose other two methods, which are those, is a qualified election fund, QUEF we call it. And the second option election is the mark to market. Now, how to use these two methods? One is qualified election fund, which means you should have a annual information system statement, AIS. We call it AIS. If you have an annual information statement coming from the fund, many individual Many Indian mutual fund companies don't provide it. If you have that one, again, the word is annual information statement. If you have that annual information statement, you can elect that QEF. Very good system, very good matter of reporting, because now based on that annual information statement, you can report the capital gains, or it can be long-term capital gains. You can report any income, earnings from there. It can be treated as ordinary income, and the taxpayer can report that every year, like we report any kind of investment here. But the word is annual information statement. If you have that annual information statement, elect, use it, use the method Q. If you don't have it and the funds are tradable, means you can determine the market rate for most of the funds. Then we come into the mark to market election under section 1296, mark to market. That's the default. That's the best method we use. Mostly mutual funds are tradable. Each year you can recognize the fair market value. How do you determine? It's based on the net asset value, beginning balance of on January 1st and ending balance of December 31st. Any kind of gain that you have in those NAVs, net asset value, you have to report as an unrealized gain, and that unrealized gain has to be reported as ordinary income on the Form 8621, added to your other income, and you pay ordinary taxes. Now, if you have losses in that year, you can claim the losses to the extent of earnings you declared in prior years. If you're not declared earnings in prior years, you cannot claim the loss in the current year. The loss will be loss will be ignored. So these are the ways and method to disclose. So if you have annual information system statement from the mutual fund companies, best one. If you don't have it, if they are tradable, marketable, then use the method mark to market and just report the unrealized gains based on the net asset value of those funds.
Yeah, and by the way, a lot of tax firms, they don't even want to deal with PFIC. Just so they would rather not deal with that client because it's so complex, takes too much time. They would just let that client pass on. Personally speaking, what I don't like about PFICs is they hurt you from long-term compounding. That's the very basic principle of investment, because you got all of these holes where the money is flowing out of that income that you're trying to generate. So I'm not a big fan of anything that is subject to PFIC, financially speaking, but I know, India is the second best stock market in the world. So if you are there and you're doing this kind of stuff, I totally understand it. Sanjeev ji, what about people who never heard about PFIC? Maybe they own these mutual funds, maybe they did some investments in India, and they didn't even know about PFIC. Now what happens?
See, the one thing which I want to make clear to all the people watching us, in India, when we go to India, every banks, financial institutions, they start to sell SIPs, which is very, very famous. That's the number one vehicle for investment in India is SIPs. And they never tell you about PFIC rules. They never tell that if you are coming from US, you are a US resident, citizen, green card holder, you will be subject to PFIC rules. They never tell, because if they say, people will not invest. So definitely that's the buzzword for investing is, oh, do SIPs. People have done that left and right. So when they have done those investments and they come forward and they come to know that, hey, I have so much investment now, the money is, let's say I invested 10,000 rupees. Now the 10,000 rupees have gone to 1 crore maybe. In US dollar terms, if you invested around, let's say, $100, now it's gone to $100,000. Now they realize I have this much money. How should I do it? Should I try to bring that money by selling it? Then when they do that, the chartered accountant may tell them, oh yes, you have to report in the US also. When they realize all those things, then they are in a fix how to do this. And with the current economic scenario and the current political scenario, the people are becoming fearing of not becoming compliant. Then they become very, very worried. They stick up, keep running. So there are ways to do it. We can use amnesty programs to make you compliant with respect to non-disclosure of the assets of the mutual funds on FinCEN 114 or 8938, or not filing the Form 8621. We can make it compliant. You can use the streamlined domestic offshore procedures for making it compliant, and penalty will not huge. Its only penalty is 5%. But there's certain processes to be followed, like for example certifications, other things. Filing the amendment returns. You can use those. We have done this for several years. And we have done this for a lot of people, maybe around 3,000 plus people. We already gone through this, and successfully, I can say, Again, we cannot guarantee anything, but we know what we are doing, and there are ways to do it. So don't hide those things. Don't worry about it. Come forward and do the compliance, and your life will be good.
And Sanjeevji, just for clarification, if somebody choose not to do it at all, they know it, they already, now they understand it, what's at risk. And if they don't come forward and report them themselves, what happens?
So the main thing is, I told you, like for example, if they put $100, it goes to 100,000, or they go to $2 million. Now the question is, if something goes wrong with their life, then how they will inherit those assets? Number one. Number two, if they want to bring that money, want to sell them, bring the money here, they are going to use the U.S. systems, U.S. banks, financial institutions to transfer money, and they'll be reporting on that one. And remember, with AI is not only useful for us, the taxpayers and other people. IRS is very much vigilant on that investment in AI. They also have that information available. And number four, if you invest that money somewhere, and let's say real estate or other ways, and that investment itself is growing too much and makes more money, and the source is not validated, the income will not be validated. When you sell it, the capital gains will not be validated. It will be subject to a lot other things. And with the kind of openness now we have with the FATCA requirements, Foreign Account Tax Compliance Act, a lot of information are being shared. And remember, in India we have KYC. If you have a mutual fund investment, every mutual fund company requires you to do KYC. That's a part of compliance with FATCA 8938. You have to give your social security number, you have to give your proof of address, you have to give your date of birth, you have to give your US citizenship card, copy of your US citizenship or US passport. So all these things are being compliant with, then you should be worried. Why they are asking all this information? They need compliance. India is also becoming very compliant in respect to foreign income disclosures because they also have their forms, and in the Prime Minister's speech, in the Prime Minister's new budget, and that they passed the income tax bill, that they passed Income Tax Act of 2024. It's make more mandatory for people who are non-resident Indians to disclose their foreign assets, and the compliance is at the highest level.
So, like Sanjeev ji said, things can get really, really ugly if you are not properly filing the report. But let me just put it in perspective so that way you can maybe comprehend it better. So, Form 8621 that Sanjeev ji just talked about. Normally speaking, IRS audits you within 3 years. Now, if you're required to file 8621, but you did not file it, guess what? IRS now no longer have that statute of limitation. They can go back, like maybe you didn't really file it 5 years, 10 years down the road. They don't care. They can go back and again, they can put you at risk. Then on top of that, they can retroactively calculate what your income should have been reported on tax return. That means your tax brackets can perhaps change from where they were. And then obviously IRS is really good at charging interest and penalties on top of that. And one important one that a lot of time people don't realize is accuracy related penalties. They can also kick in. They could be 20%, 40%, depending upon how bad things are. Just putting you in perspective. And then again, today's video is not about FBAR or 8938 or anything like that, but they have their own sets of penalties. So this can have like a cascading effect, and one little problem can turn into something big. So I would strongly urge you to avoid it if you have any kind of passive investments in India. Now, just to clarify, when we say passive, because a lot of times people think of active and passive in terms of real estate. That's not what we're talking about. We're not talking about your real properties, your rental properties. Just, so before you start panicking there. No, that's not what we're talking about. I gave you specific items that you need to look at in the beginning of the video. You can go back and listen to it. We are mostly concerned with liquid assets, like mutual funds or ETFs or life insurance policies or maybe some private companies or a group of companies that are investing their money, that kind of stuff. If you're not reporting that, that can come back and haunt you. So I think we covered it in great detail, Sanjeev. Anything we missed on PFIC today?
Yeah, I will just summarize it to say, if you are a US citizen, green card holder, resident of US, don't invest in Indian mutual funds companies. It's better you invest here in US, in the US mutual fund, or you can invest in the US through for investment in Indian ETFs. But in the US, there are also ETFs available for Indian ETF available on the US market. You can use that. If you have it, then make sure that you disclose it use the proper method, which I said, don't use the default method, excessive distribution method, because very first is the worst and punitive method. If you don't select anything, default will be there, the excess distribution method, which is, like I said, the worst case. So do choose between the QEF, qualified electing fund, or money mark to market. Qualified election fund is used if you have annual information statement and the mutual fund company provided. Then based on that statement, you can report it. If not, then use the mark to market and just report the unrealized gains. Today you're paying taxes. Remember, whatever taxes you're paying on that gain is not going to be unreported. Means you will add that income to the basis of the mutual fund. So when you sell it subsequently, your basis will be higher. You pay less taxes. So today you're paying taxes. Tomorrow you'll be paying less taxes. So it's a win-win scenario. Today you capture it. Tomorrow you'll benefit it. That's how it works.
So friends, one final reminder before we wrap up for the day. Tax season is here. We get super busy in March and April. So please try to wrap up your documentations by February and early March. So that way we can give it due attention and we can wrap it up right on time for you guys. So that is one thing that you guys can do to help us out. Our problem is a lot of people come in towards the end of March and early April. And that becomes just so much difficult because you have to wrap everybody up by the 15th. So just help us out. Try to get things done by February or early March. Hopefully by the end of the March, you're all wrapped up. Don't procrastinate. Don't delay it all the way till April. If you don't understand something, you need to have some questions, reach out to us. Call our office, go to sanjeevcpa.com or call 510-825-7563. We can help you out. And then February 7th, Sanjeev will be available to answer your questions live. So please do join that webinar. Just go to sanjeevcpa.com and register for that webinar as well. Thank you, Sanjeev. I mean, today's, we almost spent 30 minutes talking about PFIC. So this is pretty good information.
Thank you.
All right, bye-bye.